I'm Elizabeth Warren, Chair of the Congressional Oversight Panel. I'm here to introduce our special report on farm loan restructuring. It's often been said that credit is the lifeblood of American business, and that's as true in agriculture as in any other industry. Farmers borrow money to pay for land, equipment, seed, livestock, labor, and more. Any constriction in farm lending has powerful ramifications for family farms, both in their business operations and in their continued viability. While there are mixed signals on credit availability, there are some troubling signs. Farmers are increasingly turning to the Farm Service Agency, which is the lender of last resort, so that they can borrow more money. At the same time, commercial banks have tightened their lending standards. So Congress asked the panel to examine farm lending in light of today's troubled credit markets. Are farmers losing access to credit? Is the recession hurting farm income? Are more farmers defaulting on their loans? As someone from Oklahoma, I've known since I was a little girl that farming is a risky business. Even in the best of times, it is vulnerable to huge swings in commodity prices, flood, drought, crop failure, and shifts in the broader economy. What's more, different sectors of agriculture push and pull on one another. If corn prices rise, that's good for corn growers, but bad for ranchers who feed corn to their livestock. Farmers are resilient. They've adapted to these risks by expecting the unexpected and by building their business plans accordingly. Farm loans are usually better collateralized than residential loans, with a lower debt-to-asset ratio. Even though farmers may never have predicted this financial crisis, with low debt loads and some money in the bank, many are well equipped to survive it. In effect, a building built to survive a hurricane is also likelier to withstand a tornado. Against this backdrop, the panel examined the state of farm markets. Agriculture has proven itself more resilient than the broader economy. Farmers entered the recession in an historically strong position, and for many, balance sheets are still in fairly good shape. But prosperity is not evenly spread across America. Today, many farmers are struggling. Net income is expected to fall 20% this year, and in some sectors, especially dairy, the income is likely to even do worse. This could mean that more farm loans will go into default in the months to come, and the possibility of farm foreclosures grows. Congress asked the panel to consider, what then? If farm foreclosures become a critical problem, how might Congress intervene? In particular, should banks that receive TARP funds be required to reduce farm foreclosures? In the full report, the panel reviews 3 models for a restructuring mandate, all based on existing programs. Each has its strengths and weaknesses, and you can read the panel's analysis on our website at cop.senate.gov. That's cop.senate.gov. Now, a foreclosure prevention plan that works only through TARP recipient banks would have limited effects nationwide. Right now, TARP recipient banks hold only about 10% of farm real estate debt, and that share is likely to shrink further as more and more banks pay back their TARP capital. But there are other alternatives to helping farmers facing potential foreclosure, such as setting aside some portion of TARP money to create more incentives for banks to lend to farmers. To address family farm foreclosures directly, TARP could be used as a vehicle patterned on a program already in place for dealing with home mortgage foreclosures. Alternatively, Congress could increase assistance through one of the existing farm assistance programs that include commodity price supports and other actions. Congress has a long history of working to strengthen the agriculture sector and to preserve family farms. Our report documents falling farm income and weaknesses in certain farm sectors. The report also makes clear that Treasury and Congress have multiple tools available to address these problems, and that any loan restructuring mandate is just one a potentially important one, but only one piece in a broader strategy to support farm credit.